Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will explain what the big drivers were in the major equity markets. Reporting from Japan, the Corbett Report's James Corbett will tell us if Chinese nationals are still snapping up foreign real estate, why it might be harder for Chinese to get into the U.S. to invest, and just how desperate are they to make so-called clean investments at home. Author Robert Campbell of real estate timing fame believes the factors that control real estate don't change with the markets it's in. The bigger and faster the rise in real estate values, the nastier and harder the fall. Plus, at the end of our show, we'll have a company showcase update with American Manganese CEO and President Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're chatting with Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross.
Nice to be here, Jim.
Oil making unusual moves for this time of year. Maybe you can explain. I mean, we were churning over $50 a barrel, dropped down suddenly a few weeks ago. Now it's back above 50. What's going on with Mr. Crude?
They're pushing this market around. I mean, in the first 2 months of this year, they built up very, very large speculative positions, and the commercials had their shorts on. And was it 2.5 weeks ago we broke through that $52 to $53 area that had been holding in as support, got that quick drop to 47, and some of those positions got unwound. And clearly we became, I guess, a little bit too oversold. And here we are at the end of the week, we're back through 50. You would think this time of year inventories would start to build up, especially as you're in this shoulder season before we get into the driving season. But, as I say, the recent years, we've seen strength into the spring, and in the past, it's been pretty much a flip of the coin as to how much strength you would see right in here.
The Saudis again saying they may extend their production freeze. Does that make a difference?
Well, I mean, we talked about this months ago, that this is the game they're going to play here, that the freezes, instead of announcing a long-term freeze that, would be a year or two, you come out and you just do these ones that are going to be good for 3 or 6 months, and then you get the chance to play the game all over again. So I think this is just part of that posturing that's going on. And, clearly they want to see oil prices remain high as they look to do their equity offering coming up within this next year. So it's all that, from their perspective, holding this price level is pretty darn important. When we look at the oil market, and I look at the copper market, and the breaks that we had a week ago, and now these bounces, they're all coming from some pretty important interim support levels. And, without a doubt, if these rallies don't take hold and we start to erode back down through the levels that we saw in this last week and a half, I think things could become pretty heavy very, very quickly.
Of course, too, in the States, the frackers are the wild card because they can literally turn the tap on and off at will.
Oh, yeah, and their costs are, they're way down. When it comes to production these days, for all that it used to be that OPEC and Saudi Arabia was the ones that determined surpluses or not, I mean, America is so big now in terms of its production that when you do see the reductions by OPEC, clearly the Americans are capable of taking up that diminished amount. So it's the implication being that it's going to be hard for oil prices to do too much on the upside. And with, we hear about some costs that are clearly in the $20 and under range from some of the frackers. So this is pretty profitable for those fellows. Not for the Canadians up here when you've got the heavy oil, but definitely for the anything down in the U.S. side of the equation.
And of course, southern Alberta is still churning out old crude. Some of those wells have been producing for 30, 40 years.
Yep. It's amazing how long you can do that.
What's going to happen with the equity markets? Everybody keeps waiting for the shoe to drop. Are we expecting a major correction this spring? Well, we've been following our presidential cycle model. That to me has really been one of the keys. And we were looking for this mid-February high with a correction that would carry us down 3 to 7%. We've had just perfect 3% move into last week, pretty much coming to a conclusion on Monday when everybody had panicked over the Obamacare legislation, the change in the Obamacare from a week ago Friday. And that type of move is indicative, news-wise, of what you'd like to see around a low. We've got lots of good work and technicals that we think can guide us through the next couple of months here. And from my perspective, we should have some very nice readings that we can use. I'm very happy with the models that we've got at this point, and be providing those to clients and also to subscribers of Bob Hoye's Institutional Advisors letter. And I know Bob plans on doing some type of an introductory offer here in the coming weeks, so people might want to take a look at what he's got available. Ross, thank you so much for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, James Corbett, next on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he's worked and lived since 2004. Welcome back to This Week in Money, James.
Thank you for having me back on the program, Jim. Always a pleasure to talk with you.
Are people in China still trying to snap up real estate around the world?
They are, but decreasingly so. And we can take that from the latest figures that are coming out, showing the exact opposite of the problem that the Chinese government has been trying desperately to combat for at least the last few years, i.e. capital outflows. As people probably know from this program, if not others, that China has been battling a problem of money fleeing from China to foreign markets in the form of real estate investment mostly, for the last few years, based around the ever-present fear of a devaluing yuan. So people who are making their money in yuan through the credit boom that has been driving the Chinese economy for the last several years are desperately trying to get that money out into what they think would be a safer investment, i.e. real estate, usually in Western Canada or the United States, as I'm sure you know all about. But that it seems to be, the latest round of capital controls that they started implementing at the end of last year seems to be having some effect, because for the first time in nearly 3 years, those net outflows of capital from China have turned inflows. So there has actually been a slight, I believe something in the order of $6 billion inflow of capital in China from the latest month's figures. It's not a huge amount, but at any rate, it shows that there is a change that's taking place. And we will probably see, or to some extent already have, but if this trend continues, we'll see that playing out in real estate markets around the world. And this, as I say, relates to the capital controls that China has been putting in place and tightening up, especially in the last few months, specifically to achieve this very phenomenon. They want the capital inflows rather than outflows, or at least they want to staunch the tide of outflows. But, interestingly enough, this simultaneously works against one of China's long-term foreign policy, foreign security, and foreign economic goals, which is economic expansion abroad. Yuan fund operators are now complaining that they are having to cancel a lot of their projects abroad and their foreign investments because of the new capital controls, which basically prevents them from doing a lot of the investment that they have been doing. So this is, in fact, at the same time as it is reaching one of China's policy goals, it is breaking one of the others, which I think is the fundamental problem with so many central planning schemes. Whatever the government tries to do, it will have an unintended consequence somewhere else.
Well, that's just like BC Premier Christy Clark. On one hand, she brings in a foreign buyer's tax to try to cool the market, and on the other hand, she's giving $37,500 to new home buyers. So
yes, exactly. Contradictory policies. And so I just recently wrote in the International Forecaster about another aspect of all of this. Not only real estate investment has been booming from China specifically, but also investment in the U.S. government's AMY.V immigrant investor program, which is essentially a way for foreigners to buy a visa for the United States by investing a certain amount of money in creating an employment, creating business in the United States. And the long story short is that with a $500,000 investment in capital in certain target employment areas in the United States, Chinese investors could receive a visa for the U.S., and which, of course, would then entitle them to open up bank accounts and get all of their money out and all of that sort of thing, which, of course, is the whole point of this operation. Which is interesting because the capital controls mean that Chinese citizens are limited to $50,000 worth of foreign exchange transactions per year. So this is theoretically 10 years worth of savings by these diligent Chinese investors to afford the AMY.V visa. But I think we all know that they use practices which are known in the industry as smurfing to get around the capital controls. They basically divide up their exchanges into a lot of different, smaller transactions and get their friends to basically funnel the money out of the country. And this is well known and has been practiced for a number of years as people try to get around these capital controls. And that's why China accounts for the vast majority of these investor visas that are given out each year. But the U.S. government is now threatening to raise that threshold from $500,000 to $1.35 million, which is going to significantly reduce demand for those investor visas, estimated to be as much as a 90% drop in demand for them as the price reaches that price point. So that's another way that people have been funneling money out of China that seems to be that there's probably going to be a big roadblock for would-be investors trying to get that money out of China.
Well, I was just reading a report. Despite currency controls, China's so-called Warren Buffett Fosun chair Guang Chang, and I apologize for the pronunciation, says, well, we have so much money internationally, I don't have to take money out of China. And his group has bought things like Canada's Cirque du Soleil, Britain's Thomas Cook Travel, India's drug maker Gland Pharma, France's Club Med, and other companies like that. On the other hand, I think to stay friendly with the Chinese government, he says we will invest more at home. Is that the story kind of that you're getting?
Well, I think there's definitely a lot of quid pro quo that goes along with regulators. And of course, as always, with any government program and controls and regulations, the big players get to set their own agenda to a certain extent. So as long as they play ball with the Chinese government, I'm sure that there are certain accommodations made to all of these rules. And I think the key point of this is that there has been a drive towards more internal investment. But as I say, this does combat one of the other long-term policy goals of economic expansion abroad. So it is quite the catch-22 from the Chinese regulator perspective, I suppose.
How is China's real estate market?
As always, it's a tightrope. It's a balancing act between the incredible pressure of a quickly urbanizing Chinese population, again, 1.3 billion or so people, the vast majority of whom have traditionally been rural, but of course it is quickly urbanizing, which puts incredible demands on the urban centers in terms of property pricing. And of course the Chinese government wants to keep prices affordable for all these people flocking into the cities. So there's a lot of attempt to keep that lid on it. But as we have seen in recent years, when prime properties open up, people treat them as investments because, of course, they know that the prices are going to rise as demand reaches a fever pitch. So we see people literally stampeding over each other, breaking doors down whenever a new property is offered, and they open the door on the investment. Literally, people are rushing in and literally tripping over each other, and it can be quite frenetic. And I think that's kind of the picture of the Chinese real estate scene overall. And it's another situation where there's only so much that a government can do to really stem that tide of demand. As I say, as one of the largest mass migrations in human history, that of the urbanization of the Chinese population proceeds at pace.
Is China's credit bubble driving the global economy?
To a large extent, yes. It has been, for the last several years, the prime driver of global growth, generally speaking. And that's in both senses, both in the direct sense of Chinese growth is the largest share of global growth, but also in the sense that the knock-on effects of Chinese growth have an effect on global growth as well, i.e. the economic industrial activity that China is doing, of course, ultimately results in trade with the United States and other export markets that themselves spur economic activity in those markets. So China has been a linchpin of the global economic system for the last several years, certainly since the Lehman collapse. I think China has been really the center of economic growth. And that growth since that time, that 2008-2009 time span, has been not predicated on productive economic activity, manufacturing activity, so much as it has been predicated on the expansion of a massive credit bubble that the Chinese government has overseen. And that credit bubble has been really the driver of global growth over the last several years. The question has always been, how does the Chinese government grow itself out from under that bubble to prevent it from popping? And that is the ongoing question, and one that I think we're going to see coming to a head certainly in the next few years. And there's going to be a large question mark hanging over the Chinese-U.S. relationship as, of course, the Trump administration orients itself with regards to China. And I think whatever we see in terms of tariffs or labeling people currency manipulators could have a giant knock-on effect on the global economy. So I think that's really where people's investment eyes should be turned at the moment in terms of the global situation.
Is money creation slowing down in China?
There's a lot of shadow banking activity that goes on, and there's a lot of wealth management products and other exotic investments that are being made that are essentially Ponzi schemes. They require new people to come in next month to save and cash out the people who bought in last month. Those types of schemes are extremely common in China right now as people are looking for ways to invest their yuan, because increasingly they are prevented legally through all these restrictions from taking them abroad. So people are looking for very exotic instruments like that. So there's a lot of shadow banking activity that is being generated, and every time the Chinese government tries to tighten the spigot of credit, we see cash crunches that result in banking panics. So we see them opening the spigot again. And that has been the balancing act for the last few years, trying to wean people off of this credit bubble, but unsuccessfully to a large extent so far.
Is China likely to face a credit crunch this year?
I would say so, but then again, I would have said so last year, and I probably would have said so the year before that. It's extremely difficult to predict at what point the credit tide has to stop. It can continue. Generally speaking, this is an exponentially accumulating scenario where you need more and more and greater amounts of credit for it to have the same effect on the economy. So I'm not going to be Nostradamus here and give you a date on which it's going to end, but I think at some point it really does have to start turning around and start being based more, again, on actual economic activity rather than on credit. And I think that the turning of the tide from capital outflows to capital inflows, it plays a significant part in this, insofar as those yuan funds that have been looking primarily abroad for places to invest those yuan are now actively looking for places within China, which could fundamentally change both the global economy, but of course also the Chinese outlook specifically, and could be the way that this is funneled back into domestic activity rather than creating bridges to nowhere or the Chinese equivalent thereof.
Is China continuing to tighten currency controls, and are they working?
Well, as I say, specifically in November, December, in late 2016, there was a number of tightenings that were done to really make sure that they hammered down that $50,000 foreign exchange transaction limit. And as people who've been following the cyber cryptocurrency space will know, there's been a lot of tightening of exchanges, Bitcoin exchanges in China to try to stem that outflow of capital as well. So, and as I say, the fact that the capital outflows have turned into inflows for the first time in nearly 3 years indicates that there is an effect that is being had right now. So, again, it's a question of how much they want to tighten that and whether they want it necessarily to be inflows and only inflows, or whether there's some sort of balance that they can make to ensure that some of that investment does get out so that China can start to find its way internationally in terms of geopolitics as well as economic expansion abroad.
We'll have more with James Corbett next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with James Corbett, publisher of the Corbett Report. He's speaking to us from Japan. James, are cryptocurrencies now the vehicle of choice to move money out of China?
I think there may have been a sense that was a good way of moving money out of China, or at least a way of moving money out of China in the last couple of years. But as I say, I think that the recent crackdown that we've seen happening in the Bitcoin space in China has put an end to that idea, or at least the unproblematic idea that that's the easiest way to move money out of China. For people who don't know, Bitcoin exchanges in China have been largely the driver of Bitcoin's growth in the last couple of years, really. Most of the exchanges and most of the miners are now located in China. So that's a significant trend, and one that has clearly been predicated on this drive of the Chinese citizens to try to circumvent capital outflow regulations. But as I say, the big three, all big three of the big three Bitcoin exchanges in China shut down recently for several weeks as they were updating and upgrading to comply with new Chinese government regulations of the Bitcoin exchanges, and several others indicated that they had received a talking to from the Chinese government, basically saying, if you don't play by the rules, you will not play. So I think there's been a lot of pressure put on the Chinese exchanges to try to basically know their customers and make sure they're not circumventing capital controls. Now, cryptocurrency being cryptocurrency, theoretically, I mean, there's no way for, except for absolute shutdown of all internet activity and exchanging of numbers and letters essentially online, there's no way to really stop people from moving money to someone else at some other point in the globe. But since most of that activity right now is taking place through these exchanges, which are heavily regulated and monitored, I think that has stemmed the tide of the idea that cryptocurrency is going to be the savior for the Chinese people at this point.
Is China now a net seller of the U.S. dollar?
I would have to check the latest figures on that, which I do not have. I know that they have been selling their U.S. Treasury holdings in recent months and years, but I don't know at this particular moment which way they're going. I think that the overall trend is to selling off treasuries, and but at the same time, in order to counter the Chinese yuan devaluation, they have been trying to prop that up with their foreign exchange selling. So I'm not sure at this moment which way it's going, but I think overall they have been selling off their treasuries.
What do you see ahead for the yuan and the U.S. dollar?
So much of that is predicated on policy more so than I think on economic activity. Since we are in the post-Lehman era, it is the central banks and their diktats that have primarily driven global growth or lack thereof. And in the Trump era, it very well could be whatever it takes towards China that really ultimately is the deciding factor on Chinese growth in general, and then global growth based on top of that. It really does depend on whether China is labeled a currency manipulator, if they are, and how that affects, for example, tariffs that may be instituted. Again, it's still very much up in the air at this point. We know that Rex Tillerson, the new Secretary of State, did make a visit to China recently, in which, interestingly enough, he quote-unquote inadvertently used a bunch of dog whistle phrases that are common in Chinese political circles about win-win scenarios and fostering mutual respect, and all of these phrases which just sound like political blather on this side of the world. But in China specifically, that means some very specific things about China's role, and basically it sounds like Tillerson was kind of genuflecting to China a little bit and giving them a bit of importance, putting them a bit on a pedestal. At least that's what it sounds like to the Chinese ear. So that was an interesting development. What that portends in terms of the future China-U.S. relationship, I think, is, again, still up in the air, and perhaps it's not up to Tillerson to decide that. I think that's going to come more from the economic side of things. And on that side, we have people like Peter Navarro on key economic council's positions for the president, people who have literally written books about the coming war with China. So there's some very mixed signals going on at the moment, but overall, I think it does not portend well for the possible relationship between China and the U.S. And again, that has been the backbone relationship of global economic growth for the last several years. So we may be seeing a fundamental rupture point at which we're going to see some very different relations developing.
What is happening with the geopolitical tensions in China, Japan, and North Korea? I think that the stalemate is one that has been, to a certain extent, it's the outgrowth of the fact that China, with its foreign minister, offered during the real height of the panic a few weeks ago here to put all of the China's pressure, which is considerable. I think China is the deciding factor here, on North Korea to stop their nuclear program if the United States would agree to cease their annual military exercise with South Korea called Operation Full Eagle that involves tens of thousands of troops and involves such things as dropping dummy nuclear munitions on the Korean peninsula in a simulated invasion of Korea. Now, of course, officially, this is a simulated invasion of South Korea by the North Koreans so that they can practice their defenses, but I think we all realize that that is equally serving as a simulated invasion of North Korea by the U.S. and South Koreans. So it's obviously seen as a threat by North Korea, and every single year when this exercise takes place, we see something. Either North Korea tests a nuclear warhead,
or as we saw this year, they launch a bunch of missiles, not ICBMs, although they do say that they are working on and could launch ICBMs in the near future. So this is getting higher and higher stakes with each iteration. So China stepped in and said, if you will stop the military exercises, we will stop the North Korean nuclear program, to which the U.S. responded, no, fat chance. So I think China really is the deciding factor here. They really, I think, can put that kind of pressure to bear on North Korea, unless North Korea is ultimately just suicidal, in which case I don't think there's really anything that could be done to stop whatever they're going to attempt to do. But China really does hold a lot of cards here, and they did make that offer, and the U.S. just flat out rejected it.
Do you feel China feels threatened at all with North Korea working on nukes?
I think that the threat that China feels is the threat of a collapsed North Korean state. If whatever, that could take place in a lot of different ways, not just an economic collapse that involves all of a sudden a flood of North Korean migrants flooding into China, which would be one security concern for China and an economic and logistical concern. But all of the other way that could unfold is, of course, if some military event does unfold and it does involve the South Korean U.S. Takeover of North Korea, occupation of North Korea, then the U.S. is literally on the doorstep of China, which would be a security concern of a different sort. So I think that's the type of threat that they feel. I don't think that they feel the aggressive threat of North Korea against China. I think that's quite clearly aimed at South Korea, and South Korea as a proxy for the United States. Although, if North Korea does successfully test ICBMs, that at least puts the possibility of a North Korean direct strike on the continental U.S., or at least on Hawaii, on the table, which would potentially be a game change. But anyway, I think the aggressive threat, the military aggressive threat, is more aimed in that direction. I think China sees the real threat to itself being more what happens in the wake of something like that. What happens if North Korea collapses?
With this kind of nervousness, what kind of an impact has this on the South Korean economy?
Well, I think the South Korean economy has this baked into the cake to a certain extent. I mean, these types of, certainly the stakes are being raised, as I say, as the North Korea develops its technology, but this issue has been on the table for a very long time. And let's not forget, fundamentally, North and South Korea are still technically at war. They have signed an armistice, but that is just an armistice. There is still an actual war taking place. So this has been baked into the South Korean cake since the Korean War ceased hostilities. Obviously these types of things are panics and they worry, but I think the average person on the street is not necessarily thinking about this every day and worrying about it. In the same sense, like here in Japan, where obviously this is a threat to Japan. The latest missile test ended up in the Sea of Japan, not very far from where I'm sitting. Again, it's not an overriding concern that a lot of people are thinking about on a day-to-day basis here, but it's obviously a geopolitical concern and something that on a political level is taking prime importance. So I think economic activity continues regardless of whatever, the saber rattling may be happening.
Is Samsung going to be able to recover from the embarrassment and losses caused by their Samsung 7 phones exploding, their washers and dryers exploding? I heard the president of the company on television say, we humbly accept we have made failures, but we also humbly say our brand new 8 phone is going to be much better and it will change things, not just for us, but for our customers.
Yes, Samsung has gotten quite the black eye in the last few months, haven't they? So yes, that is a significant concern, and I think exactly as you indicate there, so much of this will hinge on whether or not they are able to fulfill that promise of releasing the Galaxy S8 successfully or not. I think ultimately the proof of the pudding will be in the eating, and if the S8 goes without a hitch, then certainly they will still have suffered that black eye, but at least that might be a surmountable injury. But obviously, if there are problems with the rollout of the S8, that could really be a significant blow to Samsung, perhaps even ultimately if not a corporate ending one, at least one that would end its predominance in the cell phone space. So I think so much of it really does hinge on this right now. And the corporate propaganda is appropriately and unsurprisingly rolling out at full steam right now. They're talking about how they have a dream to overcome Apple, and they're really setting their sights on being, the number one cell phone provider and all of this. So I think ultimately this is going to be a question of whether the product comes out successfully. If it does, again, there will still be that black eye. There will be people for whom they're just not going to trust a company that has had this in the past. But ultimately, they'll be able to continue. We're going to have to see how this ultimately pans out.
James, thank you so much for chatting with us.
Thank you for taking the time.
My guest has been James Corbett, publisher of the CorbettReport.com. He was speaking to us from Japan. Coming up, Robert Campbell next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Robert Campbell. He's the author of Timing the Real Estate Market, and he writes the Campbell Real Estate Timing Letter. It's available online at realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money.
Thank you, Jim. Glad to be back with you.
The U.S. real estate market is getting stronger. What's the reason behind that?
The biggest reason it's getting stronger is the shortage of inventory. All markets, Jim, move off of supply and demand, of course. Everybody knows that. Demand is holding steady, even in the face of rising interest rates. I mean, we aren't seeing an explosion in demand, an acceleration in demand. It's just kind of holding even. It's just increasing slightly, not going up a lot, but not falling a lot either. However, on the supply side, we're seeing supply down to 20, 30, and in some cases, record lows. Here in the United States, I believe we have a 3.6 month supply of homes on the market based on the current rate of sales. 6 is considered normal, and so we are well below that. And in some cases, like let's say the city of San Francisco, the United States has 3.6 months of supply. San Francisco has 0.1 month of supply, according to the sources that I read. That's 3 days, Jim. That might as well be 0. And in fact, San Francisco housing prices, Bay Area housing prices, are still going up by 6 to 7%, which isn't much. But the demand side, existing home sales are down almost 10% on a year-over-year basis. So what's holding up prices? Low supply.
We hear crazy stories about, a dozen people camping out in one home. Is that still the case?
Yes, in many cases that is the case. And interestingly, as far as the campouts, I'm not up to date on the campouts, with the campouts on the new home sales. I haven't read anything about that. However, even in the demand for houses in the United States, especially on the coastlines, is extremely strong. But also, I read a story the other day in even places like Michigan that has very affordable house pricing. If a home comes on the market, for $160,000, you can expect to have that to go into an overbid situation with 10 to 20 offers. That's how strong the demand is right now. Michigan.
Well, I guess if you like fishing, it's a good place to be.
Or you like to be cold.
And that's why we live on the West Coast.
Exactly.
Now, the Vancouver market is considered to have rolled over. Is it a bursting of the bubble or just a readjustment?
Just a readjustment right now. It has only leveled off. That I know in measuring prices, you and I talked about this before the show, Jim, that how you measure prices determines, what the chart does. For example, the National Association of Realtors in the United States uses median home prices, and median versus same home sales, and that shows home prices to be much more volatile than, let's say, the Case-Shiller index that measures same home sales. And if you measure same home sales, for example, it's still going up. Median home prices, for example, especially the reason that Vancouver has likely rolled over, is the very high end has stopped selling. So homes are still selling for the high price, but the homes that we're selling for, the old homes that we're selling that, that they were asking $4 million, those aren't selling, but the homes that are selling for asking $2 million, those are selling. So that's why, even though there's been some softness in the market, according to the price charts, the market still hasn't by any means started, gone into a crash mode at this time.
Isn't it a case that instead of people buying a shack for $1.4 million because they plan to demolish it and take over the land, they're paying $1.4 million and getting a really nice house?
Exactly. So that's why you got to be careful with the statistics on price statistics, as you and I know. What I don't know about Vancouver is how are home sales holding up, which is the primary driver of demand, which is the primary driver of price. Do you know that?
Vancouver home sales are down quite a bit. I think either people are just waiting to see if prices will go lower, or the homeowner is sitting there wondering, well, could I get $4 million for this? And if I can't, I'm not going to sell.
Yeah, I've heard that, I don't know for all homes, what percentage they're down, but how about supply? How about the supply of homes on the market in Vancouver, Jim? Is it, is that increasing or is it decreasing? My guess would be it's decreasing.
Oh, exactly.
Exactly. Right. That's the only way you can avoid a crash. Right.
Well, of course, many people said if people in Vancouver are tired of paying skyrocketing prices, just don't buy anything for 6 months and see what happens.
Exactly. And of course, if nothing's on the market, because then it's a stalemate. But that's usually not the case. People are holding on to their homes longer these days by a year or two, as opposed to compared to let's say the 10-year average. So, but within time, the numbers will come out, and there's hardly any doubt in my mind that Vancouver is going to suffer a significant decline, as is San Francisco, and we're talking the city now, because even down the peninsula, into the San Jose, Santa Clara market. Interestingly, with respect to San Francisco, in the last 4 years, housing prices doubled in San Francisco. We're talking the city. That's huge. Now, one of the softest markets in California right now, Jim, is Santa Clara. Santa Clara's on its way. It could start heading south here real quickly. I think we're at the start of a new trend, and that trend's going to be down.
Santa Clara, isn't that where the new football stadium is?
Yeah, exactly. And that's Silicon Valley, Santa Clara. That's where all the big high-tech companies, Google, Facebook, everybody else is, down. So even that market has definitely cooled, which you could probably say the same thing about the Vancouver market. Prices haven't come off that much down there yet, but I'm watching it real closely.
Do you expect to see in Vancouver what we saw in the last recession? Prices in Vancouver dropped 12% in 1 year, but within a year they were back at the same level. Is that going to be the case again?
I doubt it. I wouldn't count on that, Jim. That's not normal. And things are going to return to normal. That's what happens. That's not a normal, real estate is a cyclical business. Wherever you are in the world, it's a cyclical business, and when the next downturn comes, that it's going to fall more than 12%, and it's not going to recover as quickly. Nor is it in San Francisco. Like San Francisco is a very strong market. When the bubble burst in the United States, housing prices in the Bay Area only fell 26%, whereas for the entire state of California, they fell a little over 50%. So I mean, it held up relatively well, and they recovered more quickly. But You can't count on that happening. You don't know what's going to happen in the future, Jim. That's why you have to follow trends. You have to respect the trends. You can say, oh, it's going to bounce back real quickly. How do you know? How do you know we're going to get into that same situation again? How do you know that we're not going to turn into Japan? That after the credit market burst in 1990, housing prices have been falling for 27 straight years. I mean, Japan's not Somalia or anything. That's not a third world country. So you never know what's going to happen in this world. But if you follow trends and always stay on the right side of trends, at least financially, you're going to be doing the right thing, and you're going to be more successful than not. That's why you just can't count on anything. You don't know. This next downturn, I frankly think we're heading into a monster storm here in the United States for many reasons. Economic storm. With respect to the pension problems, the underfunded pension problems we have, the unfunded government programs that are dramatically underfunded to the tune of $100 to $200 trillion. I mean, we're talking about Social Security, Medicare, that's dramatically underfunded. And what's going to bring us down? What's going to bring us down in the United States, and which retroactively is going to affect Canada as well, because we're your biggest trading partner? Healthcare is going to bring us down, Jim. It's going to bring us down. You can't compound healthcare costs, at 8 to 10% for 30 years, and all of a sudden think the system's going to last. If the current rate of increase continues for another 2, 3, maybe will last as long as 4 years, I doubt it very seriously, the U.S. government's going to be spending 50% of all the revenue, all its expenditures on health care. And we will never get there, Jim. We will never get there because the rest of the system will collapse. That will be a collapse. And I think that's by far the most the biggest economic problem that we have to address in the United States. And frankly, I don't see it being fixed. They're trying to like fine tune Obamacare, fix the bad parts and make it better. In my opinion, that's like trying to redesign a pig so it flies.
Well, I guess if you put big enough engines on it, it would. Just like the Dorito ad.
But the problem isn't the structure. The problem is the cost, Jim. It's the cost. Medical care costs, and this is one thing that I know these numbers sound extreme, but it's not something that I'm not an extreme guy, as you know. Medical costs have to come down 50 to 80% to save the U.S. economy. That's how bad it is. 30 years ago, the American family spent 4% of their income on health care. Today, it's almost 20%.
Of course, you're the only major industrial nation that doesn't have nationalized health care of some kind.
Yeah, and I looked at health care costs, per capita, health care costs, what the average American pays for health care costs. It's more than double the world average, Jim. More than double, to kind of give you evidence that backs up my claim that health care costs have to come down by 50%.
Do governments need to give people some kind of an incentive to stay in shape so they don't get sick?
Oh, now we're talking, Jim. If you put me in charge of the healthcare system, I tell you, I would have healthcare costs down 50% within a year or two. For one thing, and I'm having fun with this, but okay, one of the things I would do, for example, if you are overweight, the healthcare premium you pay, because you are much more likely to have a disease and suffer healthcare problems than somebody that's not overweight, you're going to pay a premium for that, for your healthcare insurance. Why should I pay for that? Pay for the fact that you can't stop eating, or that you smoke, or something like that. Just like with cars. If you can't drive your car and keep it on the street, is your car insurance, you pay more than the guy that can? Absolutely. So people should start taking responsibility for their own action. Second, and everybody understand, I'm just having fun with this, trying to come up with a solution. Before you can get a driver's license in the United States, they're going to have a scale, and you got to get on it. And if it's too much, you don't get a driver's license. But those are the kind of measures I'm looking forward to. I mean, just some way to penalize people that are hurting the system and make them pay. Because that's not the case. That's not the case. Most of the people that sign up for Obamacare are people with subsidized, their premiums are being subsidized, and they're unhealthy. So it's not going to work. And how that relates to real estate, that is a good question, but it's certainly not going to help. That's why I think that sometime here in the next 5 years, another doozy of a correction's coming to the real estate market. Doozy. And in the United States, it's going to be driven by some kind of crisis, economic crisis, driven by rising healthcare costs.
Robert, before we go, can you maybe tell us a bit about the Campbell real estate letter?
Oh, sure. I wrote a book, everyone, in 2002 called Timing the Real Estate Market. I never had it in a Barnes & Noble bookstore or anyplace else, and I've sold 28,000 copies of that book from my website. That's how popular it is, and still is. And that book led to me publishing the Campbell Real Estate Timing Letter, which I've published since 2002, which is the last 15 years. And I track 19 different cities in the United States as far as the trends and when to buy and when to sell. I don't cover Canada, however, but I'm aware if people were to use the same key indicators that I use to track trends for the U.S. real estate market, if they were to use those same indicators for Canada, they would be on top of the market just as well as I am for the U.S. market.
Bob, thank you so much for chatting with us.
You're welcome, Jim. Nice chatting with you too.
My guest has been Robert Campbell, his website, realestatetiming.com. And that wraps up our show for this week. We would like to thank our guests, Ross Clark, James Corbett, Robert Campbell, and thank you for listening. Questions for our show can be emailed to info@howstreet.com. And stand by for a company showcase update with American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. We're chatting with Larry Reaugh, CEO and President of American Manganese. Larry, I hear you have an update for the company. And by the way, we're speaking on March 29th.
Jim, it's good to be back talking to you, even though the weather has been very wet. But yes, we did put out a very exciting press release today on the advancement of our recycling program. And we've shown that the lock cycle work will increase the lithium recoveries up over probably 95%. And, what I would like to point out to everybody is that, when you put it in a press release, it takes up a few lines or a paragraph, and but the amount of work that goes into something like that is very tedious and expensive, and there's all kinds of you do a cycle and you take the product off and you weigh it, and then it just goes through filtration and adding water, and it goes on and on and on. But at the end of the day, we're happy. On a continuous basis, we should be able to get very high recoveries of lithium and certainly close to 100% of the cobalt. And that's what we're after. Everybody's getting excited about cobalt. And just as an aside, as an interest, I just worked out what a Model S Tesla vehicle battery would contain in cobalt. And for 100,000 batteries, you've got 9,000, almost 9,400 tonnes of cobalt. That's a lot of cobalt in one spot. And it works at scale down when you start looking at other battery chemistries and everything like that. But we'll be working on a PowerPoint to kind of show how that works, because it's very important. A lot of I'd say 80 or 90% of the people talking about recycling out there keep saying it's it's not economic to recycle. But when you look at the value of the cathode materials and the results that we're getting, I beg to differ with them. It's going to be highly profitable, and that's why other companies are looking at it. And we're starting to get competition out there. Certainly, the most advanced competition is in the private areas, and but our chemistries are different than their chemistries, and that's where the difference lies. And we know that our chemistries work. We're not going to comment on their chemistries because we don't know, and so it's just been an exciting period of time here. And I'm getting ready to head off to Phoenix. One of our advisors, David Langtree, who has a second home down there, and he set up a meeting with us to go down there and talk to a lot of potential investors on April the 8th. So we're busy, and it's an exciting time. Of course, we're off to the Cobalt conference put on by the Cobalt Institute to present our process in May the 17th to be exact. And so we got a busy agenda, and we've been invited to other places which we will make decisions on. And it's important to note that we were invited. We're not paying to present to any of these things like NatBat or the Cobalt Institute. And this way we get to meet people that we're going to be talking to in the future sometime that are going to want our product or want to own part of it or want to make deals with us to recycle their batteries. All of these things will come out of these meetings or these presentations that we're doing at these conferences. So, I'm trying to put a lot of things into a very brief interview, but I think people overlook the fact that the company's not just progressing on its recycling, but it's progressing on its marketing strategy. And we've put hints and everything out there about just what is the value of a battery, and I'm sure that people that are very serious in the cobalt space will start looking at us, with the expectation that we could be a primary producer of cobalt, and that's important. So it's been an exciting day. We traded a lot of stock, but we ended up the same prices we started out in the morning at, but that's okay. That'll all change. I mean, as soon as more recognition comes in, that will change. And I'd just like to say that I'd like to open the floor to any questions you might have, Jim.
Well, Larry, just basically for new listeners, could you explain the patented process American Manganese has developed and what it's used for?
Well, the patented process is a process that's expanded off of our existing patents on the recovery of manganese metals from ultra-low-grade deposits, and this has certainly put us in a competitive field with the other producers of these metals. But that said and done, these metals have languished even below $1 a pound for a number of years now. So we've luckily Chemetco looked at that process, said, "Hey, we can make some changes and configures here, and we can recycle lithium-ion electric vehicle batteries." And why do we say electric vehicle batteries? Well, you got all your battery types in one mass. You get in 100 or 1,000 batteries from a Tesla Model S. Then you can work with that chemistry for several runs on a potential recycling plant. And you've got all your chemistries intact. You've got all the shapes of the batteries intact, which makes it easier to develop an automated process for opening these batteries up. And so that's the main reason. We're not looking at laptops or anything else. You can imagine slew of different configurations and sizes of batteries and chemistries that are involved in that. And certainly our process would work on it, but we don't think it would be economic. But we think that the economics in electric vehicle batteries and potentially storage batteries is huge.
Larry, where is American Manganese traded?
It's traded mostly on the TSX Venture Exchange under the symbol AMY. It's traded in the U.S. under the symbol AMYZF, and it's traded in Frankfurt under the symbol 2AM. And people can reach us at 778-574-4444, and they can email us or email me at LREAUGH@AMYMN.com, or they can visit our website, which is at AmericanManganeseInc.com.
Larry, thanks for the update.
Well, thanks, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese, on March 29th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.